Hello, thank you for having your interest in the TMAM Global Monopoly Equity Fund. I'm Ben McVicker at Magellan Asset Management and a portfolio manager for the fund. So I want to start off by giving a bit of a recap about the 2022 performance and what we've seen in the year to date. Obviously, one of the biggest things that's really been driving markets in the last 12 months or so has really been the impact first of the reflation trade, but also about the impact of the Ukraine war and the crisis we're seeing in energy markets. So what I want to do is just touch a little bit on how the strategy has fared what we consider to be reasonably well in that tough set of macroeconomic circumstances. So when we think about why the strategy has performed reasonably well despite these big macroeconomic issues, what we find is it's really about the definition of infrastructure that we apply. This is about being incredibly conservative, having a definition that's going to be really reliable and robust, almost regardless of what's going to happen in the broader environment. So what we saw is the issues in Ukraine, the impacts on the assets in the portfolio is modest. So in terms of energy markets, it is regulated assets that are not exposed to the volumes in that part of the market. And likewise, in transportation infrastructure, the exposure is really through airports. Russian passengers, Ukrainian passengers, they are a small percentage of total passengers in these airports. So the impact on the assets has been modest. The next part of performance this year is, as I mentioned, it's really been about the impacts of inflation and interest rate changes. So when you think about what has really happened in recent months, the infrastructure strategy performed quite well up until about sort of August, September. What we saw, if you think back in August, we saw a really attractive inflation print. And markets, obviously at that point in time, got reasonably concerned about that inflation print and what that would mean for interest rates going forward. And so what we found is that interest rates went up in August and September by about 135 basis points in US 10-year treasuries. During that time, the strategy traded down. This is entirely consistent with what we see from this strategy from time to time. When interest rates go up, unexpectedly, the strategy trades down in the short term. But over time, these are high quality assets and we find that the underlying businesses are protected. So when you think about the strategy and the objective that we have with the strategy, what we seek to achieve in infrastructure is an inflation plus 5% real rate of return. Infrastructure generally is very well inflation protected. Now, the 5% real return, infrastructure is not meant to be a high return, get rich quick type investment, but it's meant to be a reasonable return delivered over time and with a high degree of confidence. So when we think about the objective of the strategy, we think a real rate of return is a reasonable way to think about the strategy. In addition to which, as we look back, the strategy has been in operation for more than a decade at this point in time. And over that time, the strategy has delivered against that ideal return. So it's delivered against the CPI plus 5 objective. We think this is testament to the high quality assets that can continue to grow their business over time, as well as ultimately avoid the major risks that often comes with taking too much exposure to things like commodity prices and other areas in markets that often you'll find in infrastructure portfolios that we avoid. So moving now to 2023 and the outlook that we hold in infrastructure. So particularly one of the big things that I think people are really focused on right now is how inflation, if it gets sustained into the future, how that's going to impact the assets in the infrastructure market. So when we think about infrastructure inflation, you have to really consider that the infrastructure assets are well protected against this in terms of their underlying cash flow of these businesses. So when you think about utility assets, typically what you find is that these utilities get to earn a real return, or a fair return I should say, on the invested capital in the business. So if your costs go up, you're able to go back to the regulator and actually get those basically paid back through rates. So you've got a protected cash flow. Likewise, when you think about toll roads, airports, those assets very much, tolls as a good example. In most toll roads around the world, what you find is that you can increase the tolls on your motorway by inflation or a factor of inflation each year. A really simple example of this is the French motorway system. Each year you get to increase your tolls that you charge effectively by 70% of inflation. So the cash flows in those businesses are well protected. The other part that we really think about here is, as we look forward, obviously central banks are tightening monetary policy with an intention to try to reduce inflation. The risk is that we could be looking at a recessionary environment. In that context, when we think about infrastructure, infrastructure is a very defensive asset class. So what you typically find is that when you think about the utilities in the portfolio, running water, power, gas, these assets are going to be in demand, effectively irrespective of what happens in the macroeconomic environment. Likewise, when you think about toll roads, whilst there's going to be some economic sensitivity, you might see truck volumes come down a little bit. The vast majority of traffic is actually about people commuting, about getting to their jobs, dropping kids to school. The majority of that traffic remains well in demand in that environment. Finally, what you might see is some impact on things like airports. However, when we think about airports, the biggest theme driving airports into 2023 is not about a recession. The biggest theme driving that part of the market is actually about the ongoing recovery following the pandemic. We're still trying to see those airports get back to the 2019 levels of traffic, and I think that's going to be a much bigger driver of those businesses rather than any recession story that might play out. So when you think about the infrastructure strategy, we've been operating this strategy for a number of years now. We have found in our domestic market in Australia, there's been widespread adoption of the strategy in investor portfolios, both at the retail level, and we've also found widespread adoption around the institutional investors as well. Very typically, this is about a more defensive sleeve in portfolios. And we very much, as we think about this strategy in the Japanese market, we look forward to seeing more Japanese investors taking an interest in the strategy.
投資信託なら東京海上アセットマネジメント。